Hey guys, Sean here. Now, whether you like Elon Musk or not, he's one of the smartest people on planet Earth, and he has hinted big time of a recession that is coming. Now, people crying for a recession is nothing new. Michael Burry said that the current market slump is like a plane crash. Ray Dalio believes equities are trashier than cash, and Jamie Dimon is telling us to brace for economic hurricane. Now, this time, Elon Musk, the richest man on the earth, has come out to say that he has a super bad feeling about the economy. But it is one thing listening to what he has to say. We need to see what he's doing. Actions always betray your true beliefs. Now, he sent out an email to his executives with the subject line, "Pause all hiring worldwide," and is considering slashing away 10% of jobs at Tesla. Now, Elon Musk isn't just your typical CEO of Wall Street or hedge fund manager. He comes from the business side and he has access to incredible amounts of data for manufacturing, supply chain, financing, and sales projections, right? He's seeing the economy slow down and he's preparing for a recession. I love watching the tech sector because it is a very useful barometer of risk-taking in the economy because it is usually one of the first movers to rise when there's cheap money sloshing around the system. People really love to roll the dice and gamble on tech stocks, but it's also the first to crash to earth when risk appetite dries up, especially when money is about to be pulled away. Now, the tech industry is being decimated. Unemployment is a lagging indicator of the economy, and that means when people start losing their jobs, the economy is already doing badly, and now we are seeing the consequences of that. And the converse is true. Just because we are seeing good job numbers today doesn't mean that the economy will continue to do great in the near future. Those high employment numbers are reflecting the past. Now we can see this from the QQQ index that tracks the top 100 tech companies. The 30% fall started months ago in early January this year, and the effects are starting to show. Now, just in May, around 15,000 tech jobs were lost, and Elon Musk came out with a brutal warning. He said, "It has been raining money on fools for too long. Some bankruptcies need to happen." And that is true. We are seeing tech companies like Netflix lose 150 workers. Peloton, the exercise bike company, has fired around 2,800 workers globally, and Robinhood is axing away 300 employees. Now, this is bad, and that is the big problem with the economy since 2008. Record low interest rates that were flirting near zero, bailouts and cheap money injected by the Fed, and when it all starts to dry up, tech companies are always the ones to suffer the first and the most. Now, these are companies with insane valuations, right? Many of them are either unprofitable or growing faster than their revenue can catch up thanks to low interest rates money, right? Cheap money on loan. Now, just take Snapchat's horrific crash of around 40% after their CEO came out to say the macro environment has deteriorated further and faster than we anticipated. Now, essentially, their revenue is falling because we are slipping closer and closer towards a recession thanks to the moral hazard that was introduced by the Fed. So what do I mean by moral hazard? I'm talking about the big threat of higher interest rates and cheap money. Now, a lot of people believe that the economy in the United States is a free economy, which isn't exactly true. It is a mixed economy with regular government interventions through the Federal Reserve. And we just want to talk about the moral hazards created when the Fed prints money and lowers rates too much. Now, investors want to see growth in a company. It's natural. You put your money somewhere, you want to see a return. And traditionally, those come in the form of higher sales and higher profits, right? Companies show their shareholders that they are growing by means of a higher stock price at the end of the day or bigger dividends getting paid out. Now, the thing about tech companies is that the payoff is usually far ahead in the future to reach the promised land of eventual profits. They need to burn investor money like there's no tomorrow. And that is all great when a company is private, when it's just venture capital money. But when they go public and start raising money through selling their debt or corporate bonds, that is where things really get sticky. The thing is that every corporate bonds yield is tied to the Fed funds rate or the treasury yield, and it's always higher than the government bonds because there's always that added element of risk. Now, in other words, we need to account for the credit risk. Companies can go bankrupt, while the Fed can simply print money to bail out the US government if things really head down south. Now, what happens when interest rates starts to go up? Now, suddenly the cost of financing for these tech companies could double or even triple. So if you were borrowing at 2% rate, now it has jumped to 4%, your interest coupon payments have effectively doubled. Now remember that the Fed is about to dump $95 billion worth of bonds into the open market every single month, and this will just cause yields to jump, making it more costly for companies, especially in tech, to borrow. And right now, we are in an environment where inflation is really sky high up there, food shortages are happening globally, and fewer people have money to really pay for the tech services, right? They rather take the money and use it for the things they need, food and fuel. And even Amazon's growth is slowing, and they have lost around $3.8 billion as higher inflation is ramping up their costs, right? Things are not really looking good for the tech sector, and we need to be worried. So I wanted to take a quick flashback to the dot-com bubble. Let's fire up the DeLorean machine and travel back to time. So back in 2000, everything really imploded suddenly, right? And this epic crash happened when capital began to dry up and money was no longer easy anymore. So if we take a look at the Fed funds rate, we could see the Fed suddenly just ramp up rates from 4.6% to around 6.5%. 200 basis points was all that it needed to make the cost of borrowing too high for the tech companies, right? People started to wake up and realize that prices were just too high, and many companies were just pie in the sky ideas, and everything just came crashing down. But it wasn't just the tech-heavy Nasdaq that came crashing down to earth. The S&P 500 continued to fall for 2 years before bottoming out and took another 4 years to recover back to the previous highs, thanks to the Fed lowering rates once again. Now the point here is to really understand that when tech crashes and is deep in bear market territory, it can start really a big contagion of fear, dry up spending in the economy, and trigger a recession that could spread to other industries. And I'll keep it real simple here. So let's say you're a tech worker, maybe a software engineer earning around 200 grand a year. Suddenly you get laid off, and the effects of you losing your job will ripple throughout the economy. Suddenly you can't make your expensive mortgage payments, you cut discretionary spending, you stop dining out at restaurants, you cancel any vacation plans you would have had, and now your money is more or less just stripped out of the economy. Now magnify this situation by the thousands, tens of thousands, or even hundreds of thousands, and you can really see how bad this situation can actually escalate. And that is simply the nature of the beast when it comes to tech companies. Easy to grow when there's cheap money, and easy to crash when liquidity dries up. So what does this mean for us? I think it's very important that we keep one eye out on the tech sector, because it could really be the canary in the coal mine that tells us if a recession or at least a liquidity crisis is coming soon. Now we all know that the Fed is removing cheap money from the system and rates are going to spike, but to what extent and how bad the economy will be at that point of time, we really do not know. And if you're in the tech sector, you really gotta be prepared for the worst, and at very least, Elon Musk believes that we are heading into quite a bad recession. He believes that recessions serve a vital economic cleansing function where bad companies get burned to the ground and capital is allocated to the good ones to grow. And as investors, the difficult thing is to really identify these good companies when it's only when the tide goes out that we can see who's naked. So whatever you decide to do, it's important to watch what the Fed does, because all this talk about a recession or market crash can suddenly reverse if they decide to chicken out and to print money once again. Now we can see that back in the past, they have lowered rates every time the economy crashed. Yes, happened after the dot-com implosion, it happened after the '08 housing crisis, and in 2020 as well, not to mention all the money printing that it was injected into the system, right? Liquidity was just pumped into the financial system. And if the same were to happen, if the Fed decides to U-turn on their policy, then we can see the tech sector just rocket up as sentiment will shift from safety to risk taking once again. A lot of billionaires, business leaders, and investors are all calling for market crash together, and it's something we need to pay close attention to. Now, Elon Musk is a businessman. He understands the economy. He's in multiple sectors from EVs and energy to technology and even space travel. And as an entrepreneur who built his companies from almost nothing and almost went bankrupt twice, you can be sure that he's preparing his companies for the worst case scenario. Now, the best CEOs in the world are risk mitigators, especially when they are running a big company. They don't want their entire company to go under, so they are moving preemptively to guard against a recession. They are shifting towards preserving what they have, then gunning for growth. So listen closely to what these tech CEOs are saying, because I have a feeling down the road, there'll be more warnings from them about a crash, and even if it's not true, it could trigger a self-fulfilling prophecy and just freak people out of the market. So let me know what you think in the comments below, and if you enjoyed today's video, be sure to smash the like button and subscribe to my channel. Thank you all for watching, and I'll see you soon.